Good evening to everyone here, and good afternoon, good evening to people joining from other time zones. Thank you for joining us today for HCLTech's FY25 and the fourth quarter earnings announcement. FY25, we demonstrated resilience and growth supported by our diverse and all-weather portfolio despite the uncertainty in the global economy. I'm pleased to share that we've delivered superior growth with good control over steady profitability during challenging times. Our razor-sharp focus on clients during this period of uncertainty helped us achieve results that matched our guidance. I sincerely thank all our HCL techies for another resilient and an industry-leading performance. All the revenue numbers I'll be sharing today are in constant currency. In FY25, we clocked a consolidated revenue of $13.84 billion, an increase of 4.7%, attributed to both our services business and the software business. Our operating margin was 18.3%, a 7 basis points increase over FY24. FY25 marks the third consecutive year of our services business outpacing our similar-sized peers. In FY25, our services business achieved a growth of 4.8%. IT and business services reported an increase of 4.6%. Engineering and R&D recorded a growth of 5.5%. HCL Software also demonstrated strong performance with a growth of 3.5%. HCL Software's annual recurring revenue now stands at $1.03 billion. This year also marks a growth acceleration in HCL Software compared to FY24. Now, getting to our fourth quarter performance, our revenues declined 0.8% sequentially, attributed to the seasonality in our software business. Software business grew 2.9%. Overall, we grew 2.9% on a year-on-year basis. Our operating margin for the quarter came in at 17.9%. Our services business grew 0.7% sequentially and 2.7% year-on-year. In terms of geographies, during the financial year, all the three geographies grew. Americas, the largest IT services market, grew 5.3%. Rest of the world followed with a 4.7% increase, and Europe grew 3.5%. Shiv will comment a little more on our geographic reporting going forward a little later. This year, our leading vertical was telecom, media, publishing, and entertainment, which exhibited a very robust growth of 43.4% in FY25. Followed by retail CPG, achieved a 10.7% increase, apart from technology and services, which grew 6.7%. Further, to capitalize on the large public sector spend, we recently established HCLTech Public Sector Solutions, a subsidiary dedicated to serving state and local governments and educational organizations, as well as federal, civilian, and defense agencies in the US. I'm glad to share that even during this period of relatively slow growth, we added 6 clients in our $50 million category and 1 in the $20 million category on a year-on-year basis. Coming to bookings, we had a very strong quarter. In fact, the second highest after the September 23 quarter, which was on back of a mega deal, which all of you know. This quarter, we brought in $3 billion in net new booking. At the fiscal year level, the total new booking stands at $9.4 billion. This strong booking was well balanced across service lines, geographies, and verticals. Our engineering and R&D services business led the charter with a record high 75% growth in bookings in FY25. This demonstrates great execution of our integrated go-to-market organization. As an example, a US-based global high-tech company selected us for a mega engineering services deal to serve the rapidly growing AI-powered silicon and software-defined vehicle segments. The client will leverage our industry-leading capabilities in the semiconductor space to bringing cutting-edge solutions to the market. With respect to our pipeline, we are very pleased with the health of our pipeline. It continues to be near all-time high. even as we experience healthy conversions in Q4. The pipeline is supported by multiple deals across IT and business services, engineering services, and HCL software business. Notably, AI and Gen AI are now integral components of almost every deal. Both Americas and Europe have shown considerable pipeline growth during the quarter. We've made significant strides in AI and Gen AI, impacting both clients and our internal operations and processes. Our 4 flagship offerings, AI Force, AI Foundry, AI Labs, and AI Engineering, have seen substantial adoption and scaling in FY25. Our AI Labs continue to enable clients in their AI journey. They've delivered 500 AI Gen AI engagements for 400 clients. We're also driving industry-focused and horizontal repeatable solutions and investing significantly in driving agentic capabilities across our offerings, AI Force, AI Foundry, and AI Engineering. HCL Software is also adopting AI Gen AI into various aspects of its business. And most importantly, we had several instances where we are winning higher wallet share with existing customers as we bake in Gen AI-induced productivity gains in our bids. We were also recognized as the world's fastest growing IT services brand in 2025 by Brand Finance, increasing our brand value by 17% year on year to $8.9 billion. We've been recognized by Ethisphere as one of the world's most ethical companies in 2025, marking the second year in a row we've earned this accolade. Looking ahead, we believe enterprises will accelerate AI adoption to enhance efficiencies and drive innovation. Generative AI has 2 facets at the time of contract renewals. We expect both pricing pressures as well as new revenue opportunities. We believe discretionary spending will continue to be subdued in this environment. Geopolitical factors like tariff and deglobalization are expected to impact IT services. In the coming months, it will be an important topic to observe and monitor the ongoing developments. As I look beyond the uncertain short term, I strongly believe there will be strong growth opportunities emerging out of the market uncertainties. And finally, as mentioned in our investor release, our revenue growth guidance for the full year FY26 is 2 to 5% YOY in constant currency. EBIT margin guidance continues to be at 18 to 19%. With that, I'll hand over to Shiv to provide more details on our numbers. Thank you, everyone, and over to you, Shiv.
Thank you, CVK. Good evening, everyone. Thank you for joining our Q4 financial year 25 earnings call. Let me walk you through our financial performance for the quarter first. Starting with the revenue performance, total revenue for the quarter is at rupees 30,246 crores, which is a growth of 1.2% quarter on quarter and 6.1% on a year-on-year basis. Coming to the services side, the services revenue came in at rupees 27,348 crores, which is a healthy growth of 2.8% quarter on quarter and 6.1% on a year-on-year basis. Software revenue for the quarter came in at rupees 3,009 crores, which is a degrowth of 11.1% quarter on quarter due to usual seasonality, but still a very good growth of 5.9% on a year-on-year basis. Moving on to the profitability matrices for the quarter, our EBIT came in at rupees 5,442 crores at 18% of revenue, up 40 basis points year-on-year. On the back of seasonally strong O&D quarter of HCL Software, our EBIT degrew by 6.5% quarter on quarter and it grew 8.4% on a year-on-year basis. Net income for the quarter is at rupees 4,307 crores at 14.2% of the quarter of the revenue. Now moving on to our financial performance for the full financial year 25. Starting with the revenue performance. total revenue for the year is at 117,055 crores, which is a growth of 6.5% on a year-on-year basis. Coming to the services side, services revenue came in at rupees 105,398 crores, which is a growth of 6.8% on a year-on-year basis. And I'm pleased to report that our services revenue crossed the milestone of annual revenue of 100,000 crores this year. Software revenue for the year came in at rupees 12,049 crores, which is a growth of 3.1% on a year-on-year basis. And profitability matrices for the full year, our EBIT came in at rupees 21,420 crores at 18.3% of revenue, up 8 basis points on a year-on-year basis, and our EBIT grew 7% on a year-on-year basis. Net income for the year is at rupees 17,390 crores at 14.9% of revenue. Just an update on our return on invested capital. Our ROIC continues to improve thanks to our ongoing focus on profitability and efficient capital management. For the last 12 months, ROIC is at 37.9% for the company, which is up 411 basis points year-on-year. And for the services, ROIC is now at 45.5%, up 376 basis points year-on-year. Software also continues to improve, with ROIC at 19.9%, up 370 basis points year-on-year. Cash generation is another highlight I would like to focus your attention on. Our cash generation remains very strong. Over the last 12 months, operating cash flow reached at rupees 22,261 crores, while free cash flow generation was at rupees 21,153 crores. The balance sheet remains strong, with gross cash at rupees 30,943 crores and net cash at rupees 28,652 crores. Operating cash flow to net income conversion is healthy at 129%, and free cash flow to net income conversion is at 123%. This is on the back of our continued improvement in DSO. Our total DSO, including unbilled, is currently at 80 days, a 3 days improvement on a year-on-year basis. And now for the shareholders, our diluted EPS for the last 12 months came in at 64.09 rupees, which is a growth of 10.8% year-on-year. The board has declared an interim dividend of rupees 18 per share for this quarter, and the record date is 28th of April 25, and the payment date of the same shall be 6th of May 2025. That brings our last 12 months dividend payout at rupees 60 per share, effectively distributing 93.5% of our net income. That's all from my side for now, and I would like to hand over the discussion to Ram for an update on HR matters. Over to you, Ram.
Yep. Thank you, Shiv. Good evening, everybody. So this year we increased our employee count to 223,420. For this quarter, it's a net addition of 2,665. On a full year basis, if you recall, the first quarter we had a divestiture. If we offset for that on a full year basis, the headcount increased by 3,337. So that's a net addition through the year outside of the divestiture. In terms of freshers, this quarter we added 1,805 freshers. If you recall, we made a conservative projection last quarter to add about 1,000. We've done in excess of that. That's in line with our plans that move quarter-on-quarter basis. So on a full year basis, the number of freshers we added for fiscal 25 is 7,829. Attrition is at 13%. That's the IT services trailing 12 months attrition at 13%. It's a 24 BPS drop from the previous quarter. If you look at last 5 quarters, attrition has pretty much sort of stabilized around 12.5 to 13%. That's on the back of the new programs and initiatives that we have launched over the last 24 months. Many of these programs are not only resonating with our employees, it also catches the attention of external professional bodies. In FY25, we received as many as 26 different acknowledgements and certifications for the type of programs that we are running, which is showing results in the way we are able to attract and retain talent within the company. CVK spoke a lot about the opportunities for AI. We have spoken about investing in AI skilling. We plan for upskilling about 50,000 of our colleagues during FY25. We significantly exceeded that target to upskill about 106,000 of our people with AI skills, i.e., being prepared to take advantage of the opportunities that come in the marketplace. That's a quick brief. I'll pause here. If it's okay, we'll open the floor for questions.
Yeah. Anyone questions, please?
Yeah, hi. Hi, everyone. This is Jitendra from CM Leader. Thank you very much for sharing all the details. Looks like it's a great performance as compared to your peers, given the macro uncertainties. I have 2 questions. One with AI at center stage, and HCL is betting big on it, and of course clients also. So how do you see, which are the new verticals that you see are adding more to your business in the next financial year? Plus, in terms of your clients, which are the primary use cases HCL is solving across industries in terms of AI and agentic AI?
Yeah, so thank you, Jitendra, for your questions. Thank you for your questions. With respect to which of the verticals are we seeing a higher growth momentum, generally our guidance is given at an overall company level, so I'm not providing any specific guidance by industry. But AI adoption is happening across all industries. It's pervasive across all our existing clients, new deals, all of that. Now, what are the typical use cases? We broadly classify them into 2 categories. One is service transformation, which is all the services that we deliver. How can they be delivered much more efficiently using generative AI, right? That's where we have a platform which is a resounding success. AI Force is already deployed in about 35 customers, and we have a plan to deploy it to about 100 customers in FY26. The second theme is value stream innovation, which is in different industries. There are use cases like health clinician assistance is one example, trade surveillance is another example. There are about 100 different use cases across different industries, and we are selecting the use cases which can be repeated across multiple customers in a specific industry. So we call that as IFRS, Industry Focused Repeatable Solutions. The second thing is horizontal solutions. Like, for example, contact center transformation. How can we use generative AI to drive faster and a much better client experience using contact center transformation? So there are similar, that solution can go across all verticals. So these are called as horizontal repeatable solutions. So these are the 2 areas we are investing in value stream innovation. That's broadly my response. Yeah.
Hi, Annapurna from ET here. Firstly, on the guidance, your FY26 guidance is lower than the FY25 guidance, but of course a little bit more upbeat than your peers so far. Can you explain more of your thinking on where specifically you expect to see some impact of the tariff uncertainties, etc., but also any points of optimism or what levers you're looking at to have a better outlook than your peers. Secondly, on the AI projects, you said that there were some pricing pressures and in addition to gaining wallet share as well. Can you explain a bit more on the pricing pressures and how you've been navigating that? What have you been proposing to customers and sort of their evolving demands, what they're wanting to see from the AI solutions? And thirdly, for FY26, what are your hiring plans? Any numbers you can share on that?
Okay, a lot of questions. Thank you, Annapurna. Tariff impact, we expect, we haven't seen any specific impact so far. But in terms of impact, we see this play out much faster in consumer and manufacturing segments. But if the tariff impact were to play out, I don't think any vertical will be left behind. All industries would get impacted. However, this is going to, the tariff, the biggest impact will be on the costs for clients and their intention and their kind of focus on using generative AI to drive high efficiency in every aspect of their business will become the center stage of all the conversations. So we believe while there is uncertainty and there is going to be definitely a deterioration in the discretionary spend, we think AI-led efficiency is really the biggest theme where there can be large opportunities. We have a strong pipeline, and while there is conservatism in the way we look at our guidance at the lower end, overall we think this is a great opportunity to create significant opportunities for us in the market. In terms of pricing pressure related to AI, obviously when you're able to deliver at a much more efficient operating levers, then obviously we share some of the benefits with our customers. So there will be a deflation due to that. But with every renewal and every client conversation, we are able to ask for a higher wallet share of their spend as we proactively provide them the benefits due to generative AI.